Hello everyone, welcome to Value Shield Consulting's YouTube channel. In this video, we discuss the use of extra cash to either pay off debt or invest. This is a decision that is subject to many considerations. For instance, your risk appetite, the costs involved, that is interest, and your credit score. Investing is putting money in an investment vehicle that gains value over time. For example, mutual funds, real estate, bonds, and stocks. On the other hand, debt is money owed and is often subject to interest. In the first scenario, we look at when it's a better option to invest your extra cash rather than to use it to pay off debt. It may make sense to opt to invest your extra cash if the return in investment is higher than the cost of debt in terms of interest. For instance, if you have a loan whose interest rate is 8% and a government bond whose interest rate is 15%, it may make sense to invest in the bond and then use the profit you gain to later pay off the debt. However, you should also consider your risk appetite. If you have a low risk tolerance, it may be better to opt to pay off your debts for your own peace of mind. You should also consider your credit score. If your current credit score is already low, it may be worth putting in your extra cash in paying off debts rather than investing them when the interest rate earned from investing is higher. Credit scores are often considered by employers when hiring and by lenders when lending out cash and assets. The second scenario or option is to do both, that is, to use your extra cash to both pay down debt and to invest. Especially if you do not already have an emergency fund, it may be prudent to put in your extra cash into creating an emergency fund or sinking fund. For example, by investing in a money market fund where cash can be easily accessed. You may then choose to use your remaining extra cash to pay off your debt. Which option do you prefer? Using your extra cash to invest or to pay off debt, or for both? Comment down below on what you think. Once you decide to put in your extra cash to pay off debt, create a plan on how to go about it. If you have sufficient extra cash to pay off all your debts, then you can do it all at once. This will save on the interest that's charged on the loans over time. On the other hand, if you do not have sufficient cash to pay off all your debt at once, as it is in most scenarios, you should prioritize your debts by paying the high-cost debt first and paying the rest using the same criteria. For example, if you have a 12% loan, an 8% loan, and a 3% loan, it will be more prudent to pay off the 12% loan since it has the highest interest rate, and then the 8% loan, and then the 3% loan. If your current cash flows cannot sustain monthly loan payment plus interest, then you need to approach and negotiate with your lender to restructure your debt. Thank you for watching this video. I hope you found the information shared insightful. Kindly like and subscribe to our channel for more content.